Hi, I'm Andrew Drain from Ray White Seven Hills and welcome to my February market wrap. Well, CoreLogic's National Home Value Index posted a 0.6% gain in February, the 17th consecutive monthly increase in the national index. While housing values are generally rising, the pace of growth in the national index has trended downwards since April last year. February's growth of 0.6% marks the lowest monthly growth reading since October 2020 and is down from 1.1% in January and a cyclical peak of 2.8% in March 2021. According to CoreLogic's Director of Research, Tim Lawless, every capital city and broad rest of state region is now recording a slowing trend in value growth, albeit with significant diversity. Sydney and Melbourne have shown the sharpest slowdown, with Sydney negative 0.1%, posting the first decline in housing values since September 2020, while Melbourne housing values remained the same at 0%, they were unchanged over the month. Following similar results in December, they had 0.1% or negative and January positive 0.2%. Conditions are easing less noticeably across the smaller capitals, especially Brisbane, Adelaide and Hobart, where housing values rose by more than 1% in February. Similarly, regional markets have been somewhat insulated to slowing growth conditions, with 5 of the 6 rest of state regions continuing to record monthly gains in excess of 1.2%. With a trend in housing values losing pace over the last 11 months, the annual growth trend turned in February. Nationally, home values were 20.6% higher over the past 12 months, down from what is likely to be the peak rate of annual growth recorded at 22.4%. That was last month. Regional Australia continues to record a substantially higher rate of growth in the capital cities. Over the past 3 months, housing values across the combined rest of state regions increased at more than 3 times the speed of housing values across the combined capital cities, which was 5.7% and 1.8% respectively. Although the rolling quarterly rate of value growth remains rapid across regional Australia, conditions have eased from a recent peak of 6.4% over the December quarter, and that's down from a cyclical peak of 6.6% recorded in April of last year. Regional housing markets are immune from the higher cost of debt as fixed-term mortgage rates rise. These markets are also increasingly impacted by worsening affordability constraints as housing prices consistently outpace incomes. However, demographic tailwinds, low inventory levels, and ongoing demand for coastal or tree change housing options are continuing to support strong upward price pressures across regional housing markets. My belief is that the slower growth conditions in Australian housing values goes well beyond the rising expectations of interest rate hikes later this year. The pace of growth in housing values started to ease in April last year when fixed-term mortgage rates began to face upward pressure. Fiscal support was expiring and housing affordability was becoming more stretched. With rising global uncertainty and the potential for weaker consumer sentiment amidst tighter monetary policy settings, the downside for housing markets has become more pronounced in recent months. Nationally, the total number of properties advertised for sale over the 4 weeks ending 27 February was 13.3% lower than the same period a year ago, demonstrating an ongoing shortage of available housing to purchase, at least at the macro level. Despite low total listing count, advertised supply levels are gradually normalising after tracking close to 25% below the prior year's level before spring of 2021. While some cities such as Melbourne and Sydney have seen advertised stock return to more normal levels, other Australian capitals are continuing to record extremely low inventory. In Melbourne, advertised stock levels are now above average, tracking 5.5% higher than a year ago and 4.7% above the previous 5-year average. The trend is similar but not quite as advanced in Sydney, with total advertised stock at 6.3% higher than last year, but still 4.2% below the previous 5-year average. The cities where housing values are rising more rapidly continue to show a clear lack of available properties to purchase, so that's supply and demand. Total listings across Brisbane and Adelaide remain more than 20% lower than a year ago and more than 40% below the previous 5-year average. The trend toward higher overall stock levels in some cities can be attributed to a combination of more newly listed properties coming to market, coupled with softening in demand caused by worsening affordability, higher mortgage rates, and lower levels of housing-related sentiment. The flow of newly listed properties was 11.3% higher than a year ago in February and 1% above the previous 5-year average. The pace of rental growth has shown a subtle rebound over the past 2 months, which can partially be attributed to the seasonal strength in rental markets through the first quarter of the year. Nationally, CoreLogic's rental value index was up 0.8% in February, holding firm from January also at 0.8% and up from the 0.6% growth recorded in December. The February rise in rents was focused within the unit market, with the national unit rental index up 0.9% over the month and 2.4% higher over the rolling quarter, compared to 0.7% and 2% for houses respectively. The stronger trend in unit rent is most visible in Sydney and Melbourne. Demand for unit rentals in these cities has been bolstered by a combination of worsening rental affordability, deflecting more demand towards the higher density sector, where rents tend to be lower, and demand starting to return from overseas arrivals. With the pace of growth in housing values softening while rental growth holds reasonably firm, the gross yield profile has finally stabilised at 3.2%, the lowest rate on record. Sydney 2.4% and Melbourne 2.8%, which have the lowest yield profiles, recorded a slightly strengthening in gross yields this month as rental growth nudges higher than growth in housing values. According to Mr. Lawless, we're seeing rental yields moving through the bottom of their cycle. After several years of yield compression where gross rental yields reached historic lows across most of Australia's capital cities, we are finally seeing an early evidence of yield repair. If rents continue to rise faster than housing values, which is a strong possibility in Sydney and Melbourne, yields will continue to improve, making it more attractive for investors to buy property. Well, that is the February market update. The housing market is showing signs of stabilising, but we have still seen very healthy growth over the past 2 years. We are seeing solid numbers at our open homes and good buyer activity here in our neck of the woods. I'm Andrew Drain from Ray White, Seven Hills, the Drain Group. I'll see you again in April when we analyse the March 2022 market trends. We'll see you then.